Welcome to the Deep Dive. This is where we sift through the information you send us, looking for those really important insights, those aha moments. Today, we're digging into an iconic brand, Levi Strauss Co. We're looking at their latest financial results and what they see coming down the road. You've given us their second quarter 2025 press release, plus a couple of articles analyzing how they're doing. So our mission today, let's unpack these numbers, figure out the strategy behind them, and, well, see what a brand like Levi's can tell us about navigating today's really dynamic global market.
Absolutely. And what's really interesting here, I think, is you've got this brand, 172 years of history, right?
Here.
But this latest report, it's full of significant shifts, forward-looking strategies. It's not just resting on its laurels. We'll be connecting those reported figures to, the bigger picture, their transformation, how they're handling big challenges like tariffs. It shows even the giants can pivot.
Okay, so let's unpack this quarter then. It looks strong on the surface. I mean, the press release headline jumps right out. Reported net revenues up 6%. Organic net revenues up 9%. That sounds great, obviously. But what do those numbers, really tell us? What stands out most to you?
Well, those headline numbers are compelling, no doubt. Overall, net revenues hit $1.4 billion. And that's 6% reported growth, 9% organic growth compared to last year's Q2. That's pretty solid. Just quickly, organic basically means they strip out things like currency swings or acquisitions. So you see the core business performance, right? And the main Levi's brand itself, a very healthy 9% organic growth globally. But for me, honestly, the real standout, it's the direct consumer momentum, their DTC channel. This is their, and they highlight this, 13th consecutive quarter of global DTC comparable sales growth. That's consistency. DTC net revenues climbed 11%, reported 10% organic. And here's the kicker. DTC is now half their total net revenue, 50%.
Wow, 50%.
Exactly. Even e-commerce was up 13%. Wholesale wasn't bad either, up 3% reported, 7% organic. But hitting 50% DTC, that's more than just a number. It signals a fundamental shift for Levi's. They're moving from just being a wholesaler to building that direct relationship, which unlocks so much in terms of data, personalization, margin control, things many older brands find tough.
Yeah, that is a huge shift in the business model.
Yeah.
So connecting those dots, what does that channel mix change, especially the strong DTC growth, actually mean for their bottom line, for their profitability?
Oh, it means a lot. And you see it clearly in the numbers. They managed a really impressive gross margin expansion. It went up 140 basis points. That's 1.4 percentage points, which is significant.
Okay.
Yeah, up to a record 62.6%. And the report says this was mainly driven by lower product costs, yes, but also, crucially, that favorable channel mix. DTC just generally brings in higher margins than wholesale, and it flows down. Their operating margin saw a big improvement, too, 7.5%, way up from just 1.5% in Q2 last year. Adjusted EBIT margin, that's earnings before interest and taxes, a key operational measure that jumped 190 basis points to 8.3%.
Okay.
And then adjusted diluted earnings per share, which investors watch closely, leaped 37% year over year to another $1.22. Adjusted net income, $89 million, up from $65 million. So it shows they're not just, selling more jeans, they're fundamentally improving the financial health of the company.
So beyond just the revenue and the margin numbers, which are impressive, these results seem to paint a picture of, tighter operations too, better efficiency. Would you agree?
Absolutely. It definitely tells you they're keeping a close eye on costs, getting more bang for their buck as sales go up, take their adjusted SG&A expenses, selling, general, and administrative. That's everything from marketing to HQ costs. As a percentage of sales, adjusted SG&A actually leveraged 50 basis points. It came down to 54.4% compared to last year.
Leveraged
Meaning those costs grew slower than their sales did, which signals, better efficiency. They're scaling effectively.
Interesting. Okay, let's broaden the view a bit. How are different parts of the world, or maybe the other brands they own, playing into this success story?
Yeah, that diversification is important. Even though Asia was flat this quarter, organically speaking, the overall picture shows pretty broad strength. Europe, for instance, was really strong, up 15% on an organic basis.
15%? Wow.
Yeah, and the Americas were up 9%, with the U.S. itself growing a healthy 7%. So, good performance in key markets. Asia, like I said, was flat organically for the quarter, something to watch maybe, but not dragging down the overall result. And it's not just the Levi's brand, right? Beyond Yogi, their other brand, saw net revenues increase 12%, both reported and organic, which highlights that they are successfully expanding beyond just core denim. It feeds into that whole denim lifestyle brand idea they talk about.
And now here's something that really jumped out at me from the materials. We hear a lot about rising tariffs, trade challenges. Yet Levi's is actually raising its full-year guidance. How does that work? How do those two things square up?
That's a crucial point, isn't it? And it really speaks volumes about their operational resilience, I think. The CFO, Harmit Singh, he addressed it directly. He said, basically, given our strong first half and the momentum we're seeing, and despite higher tariffs, we're raising our full-year revenue and EPS expectations.
So they're confident?
Very. They've lifted their reported net revenue growth forecast for the year to 1% to 2%. Now remember, they previously expected a 1% to 2% decline. That's quite a swing.
Huge.
And organic net revenue growth raised to 4.5% to 5.5%. On the earnings side, adjusted diluted EPS guidance is up by 5 cents, now $1.25 to $1.30, which incidentally beats what Wall Street analysts were expecting. They were calling for around $1.23.
Okay, so if they're acknowledging the tariffs but still raising guidance, how exactly are they managing that? What's the strategy to mitigate that tariff hit, which could really hurt other companies?
Right, that's the million-dollar question, isn't it? It's a strategic balancing act. Their updated outlook does assume those higher tariffs stick around U.S. tariffs on Chinese imports at 30% and rest of world at 10%. Now, they did slightly trim their gross margin expansion forecast for the year from 100 basis points down to 80, that 20 basis point difference. That's the estimated tariff impact baked in.
Oh, okay. So they're absorbing some of it there.
Exactly. But they still expect expansion overall. And Singh mentioned their strategies. Things like, well, raising prices where they can, but also shuffling their sourcing. He specifically mentioned procuring products from 28 different countries. That diversification helps offset reliance on any one region hit hard by tariffs.
28 countries. That's complex.
It is, but it shows agility. So, the fact they're raising guidance despite tariffs is not just luck or good cost control. It really points to a sophisticated, flexible supply chain. It underlines how critical that kind of diversification is now. It's a lesson for, well, pretty much any company in the apparel space today.
It really is quite something to absorb that kind of hit and still come out looking stronger for the year ahead. You could wonder, though, does managing that pressure mean they have to cut back elsewhere? Like maybe less marketing spend or slowing down product innovation to make the numbers work? Any sign of those kinds of trade-offs?
That's a fair question. Where does the money come from? But Harmit Singh's comment suggests it's less about robbing Peter to pay Paul and more about a fundamental shift. He framed it as the continued inflection, his word in their financial performance being a direct result of our laser focus on the core Levi's brand and our DTC-first strategy.
So it's the strategy paying off.
That seems to be the message. They see themselves fundamentally transforming into a company with, and I'm quoting again, a higher growth rate, higher margin profile, stronger cash flows, and higher returns on invested capital. So it's presented less as a reaction to tariffs and more like the underlying strategy itself is jolting the resilience needed to handle things like tariffs.
Right, building a stronger foundation overall. Makes sense. Of course, for a lot of our listeners, these operational details and financial results ultimately matter in terms of, well, shareholder value. What's the story there for investors?
Yeah, good point. They seem focused on returns.
Yeah.
In Q2, the company gave back about $51 million to shareholders. That's an 8% increase compared to last year's Q2, mostly through dividends. The Q2 dividend was 13 cents per share.
Okay.
And looking ahead for Q3, they've actually declared a higher dividend, $1.14 per.
Berets, nice.
Yeah. And then there are share buybacks. They still have authorization to repurchase another $560 million worth of shares with no set deadline on that. Plus, they recently sold off the Dockers brand, and they stated they plan to use at least $100 million from that sale, specifically for more share buybacks. So yeah, definitely signaling value back to shareholders.
Okay, so summing up, we've looked at Levi's hitting some really strong numbers in Q2, but maybe more importantly, they're confidently raising their forecast for the whole year, even while dealing with these pretty significant tariff headwinds. It really paints a compelling picture, doesn't it? A classic heritage brand that seems to be adapting, maybe even thriving, in what's a really volatile market.
It really does. And maybe this prompts a question for you, the listener, to think about. What does Levi's success here navigating tariffs, shifting so hard towards DTC, what does that reveal about the wider apparel industry? What other long-standing brands out there might need to make similar kinds of strategic pivots, similar big changes to make sure they have, as Levi's puts it, a bolder future to avoid getting left behind?
Something definitely worth considering. We hope this deep dive has given you a clearer, maybe more informed view of Levi's latest performance and the strategic levers they're pulling right now. Until next time, keep digging for those insights.